Hi, I'm Wayne, and this is Wayne's World Built by Real Estate. Hey, I wanted to talk to you today in regards to if you are ready to buy a home. Well, there's a number of things that should be taken into account. Before you even start looking for properties and looking for what's out there, best thing to do is first of all, get yourself pre-qualified. There's nothing worse than going out, finding your dream home, and then finding out you can't afford that house. The first thing to start with is everybody looks for rates. Well, there's a number of things you need to know ahead of time. First of all, there are different ways to borrow. You can borrow from a family member in what they call private lending. The most common is to take out a mortgage with either a mortgage company or a mortgage broker. Remember, you are basically buying a product. You're buying a mortgage, just like you're buying a TV or buying a car. You need to shop for these things. You need to look around, and you're the one in charge. You're the buyer, not that other person, not that lender or whatnot. They're going to help you get through the process. But remember, you're really in more control than they let you think. When you are out there looking, the differences between a direct lender and a mortgage broker is a direct lender is such as a bank, a Citibank, a Citizens First Bank, whatever bank it may be out there. They usually will go ahead and they will originate or make the loan for you. They'll take you through the whole process. And then they'll also service the loan. So that's who you're going to make your mortgage payments to. That's who's going to pay your taxes. That's who's going to pay your insurance for you, which is part of your mortgage payment. And a mortgage broker, they go ahead and they originate the loans. They make the loans in accordance to the lenders that they sell to behind the scenes. So they're following whatever lenders they're working with. And they might be working with many of them. And they're going to shop your loan around to who gives them the best price for the loan. So most all lenders nowadays, if you're taking out what's called a conforming loan, which meets the Fannie Mae Freddie Mac guidelines, they're all going to follow pretty much the same guidelines. Next thing you should do is look at the rates. And there's two different pieces of this. You'll notice when you're looking at rates, there's both an interest rate and there's an APR. A lot of lenders don't really like to give you the APR because it shows that the farther apart those two numbers are, the more fees they're charging you in the origination of the loan. So the more that loan's really costing you. So just because it has a really good rate does not mean it's the cheapest one in the long run for you. You need to look at some of the differences in the fees that are charged, what they're doing out there. The interest rate is the rate that's on the mortgage note itself. That mortgage note is the rate you're going to pay for the length. In today's market, people are getting in the mid-3s if you've got good credit. You could be in the 4s on an investment property right now. With regards to buying properties, things you should know about is it a fixed rate mortgage or an adjustable? In times when we've had really high interest rates in the past, adjustable rate mortgages were common because you could get into the mortgage much less than the current mortgage rates. Today, fixed rates are what's out there and most people are using. Reason being is the fact that rate stays the same for the entire length of your mortgage. And we have unprecedented low rates at the present time. You get stuff in the high 2s up to the 4s, depending, of course, on your credit rating and the type of loan you're taking out, whether it's a 15-year, a 30-year. Those are all factors you want to look at. Another term you should really know about is points. When they say a point means 1% of the mortgage. So if you pay a point, your interest rate on the mortgage will actually go down a little bit. It's a very good idea to calculate out how many months of reduction in that interest rate is going to save you and whether or not it makes sense for you to pay that point up front. Just because you're getting an extra 1/8 or 1/4% off the rate doesn't mean it's cost effective for you. A lot of people do refinance their loans in the future. They want a bigger loan. They want to pull cash out. So you really want to look at how long you think you might have the loan. It's sometimes not cost effective to pay points up front. And then the other thing you want to look at are different, what we call junk fees. These are fees that go directly to the lender in addition to what they're going to make on the loan itself. This goes directly to the lender or the person making the loan. They could be anything from a loan processing fee, an underwriting fee, these other fees. Some of them need it in order to stay in business because that's just what it costs them to do their business. But in any case, this is the fees that are going to add up. They're going to go from your interest rate and take you up to the APR. Do look at that spread when you look at things. Normal costs you should expect with any lender: an appraisal, a survey, a flood certification, a tax certification. Some communities require inspections, some towns and cities that a buyer would have to pay. You may also have to pay for mortgage insurance, which if you're putting down less than 20% on a conventional mortgage is very common. The next thing you may have to actually think about too is whether your house is in a floodplain. You might have to pay flood insurance. These are things that are required in order to just make any loan. The next thing you want to think about is once you're pre-qualified for the mortgage. After you've done that, Then you can go out and start looking at homes, figuring out what it is you can buy. Do you have enough down payment? Do you have a source of down payment that maybe you're not tapping that you might be able to use that could raise how much you're getting? You also want to make sure, do you have what it needs to get there? Do you have the down payment in the bank? Do you have it in something that's very liquid, such as cash? Do you have the closing costs they're going to be needing? The lender will be able to give you what closing costs you're going to need in addition to your down payment. Also, do you have a reserve after closing? A lot of times this is not required, but it's a very good idea to have a few $1,000s saved up. You never know when a hot water heater, heating system, something else goes and you need that cash to pay those bills. You don't want to get into debt with a credit card or something else right after you buy a house if something does go wrong. Well, this has been Wayne with Wayne's World Built by Real Estate. Please make sure you subscribe. I'd love to hear your comments. Thanks.